What's going on, my fellow wealth creators? Matty S here. In this video, we're going to talk about some of the lies that are used to sell IUL, Index Universal Life Insurance. I wasn't planning on making a video today, but I just saw these videos on LinkedIn and it just got my blood boiling a little bit, because this is the kind of crap, the garbage that is out there that convinces people to purchase IUL. I know this because this is the type of crap that almost got me to dump a pretty significant amount of money, at least for me anyways, into an Index Universal Life policy without knowing the cons, the disadvantages, the things that can go wrong, the risks involved. I was never shared that side of the story until the very end. When I was about to pull the trigger, I had only heard about how amazing these things are and all the benefits, right? And I just I can't believe what I'm hearing from these people, these two gentlemen in these two videos, talking about, one of them says you're going to average 9 to 12%. He says these things typically do 9 to 12%. What are you talking about? Please show me an IUL that has averaged 9 to 12% over the last 20 years. We're going to get into what he's talking about, because it's important to understand where they're getting these numbers, even though they're just fake made up numbers to begin with. But where does that come from, right? Where's he getting 9 to 12%? Well, it's what it says on paper, okay? But then when reality hits, when we come back to the real world, all of a sudden we're not getting anything close to that. And that's why there's tons, I'm not going to say tons, there's a good number of class action lawsuits being filed against IUL companies and agencies that are selling this crap, because the way they market it is so freaking misleading. So we're going to get into that one. And then there's another video where the gentleman is talking about creating positive arbitrage within the policy, where you only borrow at 4%, but then you earn 6% on average in your policy. Guys, run away from this kind of crap. Here's the thing. You can actually create positive arbitrage with a cash value life insurance policy. But here's the thing. We're not trying to create positive arbitrage in the policy. We create positive arbitrage outside of the policy based off of how we use the policy loan. Let me give you a quick example. I borrow from my whole life insurance policy, custom designed, dividend paying whole life insurance policy, specifically designed to implement the infinite banking concept. It's really, really powerful when done correctly. Okay. I can borrow, I just borrowed at 6%, and I lent it out at 13% plus 1 point on a private real estate deal. That's positive arbitrage. But here's the thing. If I borrow at 6, but my policy on average earns about 4, well, what does that make you think? How do you feel about that? Oh, that's really bad, right? It's not. It's not nearly as bad as people will say it is. And I don't really care what the discrepancy is there. Now, I'm going to pay attention to it. If I can get a better interest rate by maybe doing a cash value line of credit, I'll do that. Okay. But I'm not concerned that my interest rate is higher on the loan than what I'm earning in the policy. And here's why. There is a huge difference between paying simple interest and earning compound interest, guys. I've run the numbers on this. I've done this on my channel. Okay. I've shown how you could pay 8% on a policy loan for a vehicle, only earn 4% in the policy, and over 5 years, you still earn more money than what you paid. How is that possible if the difference in the interest rate is double, right? It's because there's a huge difference between simple and compound interest, all right? So that's why I don't really care about the loan interest rate, particularly because I'm using it to build wealth. I'm not trying to create positive arbitrage within the policy, which is what this gentleman is promoting. I create positive arbitrage outside of the policy with how I would normally build wealth, okay? So anybody that's selling you this kind of crap, where you're going to get 9 to 12% on average, and you're going to create positive arbitrage within the policy because you can earn on average 6% and only pay 4%. Well, it comes down to what you're using the policy loan for. Why would we just borrow from the policy just because we're going to pay 4 and earn 6? Like it's going to earn 6 in that example anyways. So why do we care what the positive arbitrage is unless we're using the money to build wealth, to make investments, to acquire income producing assets, whatever that might be, right? It's a ridiculous selling point. So anyways, let me share my screen. Let's watch the first one. This is the one where he's going to claim that you earn an average of 9 to 12% per year in your IUL. Yeah, buddy, please show me an IUL that has averaged 9 to 12% per year over the last 10 to 20 years, whatever. Please show me that. He's likely talking about one of these crappy volatility controlled indexes or proprietary indexes, whatever, that are that have resulted in massive class action lawsuits because of how misrepresented they are. They they look really good on paper, guys. But it doesn't account for any major financial fluctuations, events, or anything like that. No changes in the market or financial environment whatsoever. And then as soon as they go live, a lot of these indexes are only like 3 to 5 years old. And that's what we're going to roll the dice on our financial future on. So it looks like it does really good on paper, but when then reality hits, not so much. So let's see what he has to say.
So if you have a child or a grandchild or somebody that you want to set up for life, you got to hear this. So within a cash value life insurance policy, because of the idea of infinite banking, if you put away $500 a month for this child until they're 18 years old, by the time they're 18, you can pull out $30,000 a year for college for 4 years. Now,
so first off, you don't use IUL for infinite banking, guys. Please don't. You could try if you want to, but it's likely going to be a disaster because of how many things that could be changed, how many things go wrong. What happens when you take a policy loan, a participating policy loan, and let's say you do a real estate deal, but then you have a 0 year. Well, now you've just added a lot of additional cost into the deal because you didn't actually earn any interest on that 0 year, but you still have to pay interest on the policy loan. So now you're going backwards in the deal. You don't want to be doing infinite banking with IUL. And also he's making a lot of assumptions here. Like when IUL agents throw out just random numbers that you're going to be able to earn, pull out $30,000 per year for college. So let's assume 4 years for college. So you're just assuming that you're going to have enough cash value in this thing, $120,000 if you're going to be able to pull out over 4 years. Maybe not. Who knows? But that sounds really good when you hear it, right? But it's just a bunch of assumptions. Like he's just assuming that the policy is going to do X, Y, Z when you actually don't know what it's going to do over the long run because number one, the stock market doesn't go up every single year. Number two, the stock market has far little to do with the performance of an IUL over the long run because you're not actually invested in the market. You don't get dividends. There's an option strategy involved, meaning there's a cost of call options, plus there's an options budget that needs to be generated by the general fund in order to implement that call option strategy. All of those things can change. Cap rates can come down, participation rates, spread charges. There's so many things that can change. So how on earth do you know that you're going to be able to do anything that he's talking about? Just something to consider.
Now, let's say they're 25, they can pull out $50,000 for a down payment on a house. Let's say that they're 30 and they want to get married, they can pull out another $30,000 for their wedding, and then they're just going to let the money grow until they're 60 years old and they want to retire. And guess what? If they just earn 6% a year within a policy, and on average these earn about 9 to 12% a year, that's about $400,000 a year starting at age 60, all tax-free. Everything set your child up for life.
Everything he just said was completely made up. So he's assuming it's going to do 6% on average. Like that's the conservative number. Okay. But then he says they actually average 9 to 12%. This is ridiculous. Now, here's the thing. Can an IUL maybe average 5 to 6%? Sure. All right. But that's not what he's selling you on. He's saying that you can do, on average, they do 9 to 12%. Show that to me. Show me an in-force illustration where it has done 9 to 12% over the last 15, 20 years, because you need a good amount of time to get a realistic average. You can't just take 2 or 3 years, 5 years of a policy that's maybe has been bailed out by the greatest bull run of our time over the last decade or so. Okay, but it has to be in force for a reasonable amount of time to show an accurate actual average rate of return. 9 to 12%, bro? Really? Okay. You guys want to roll the dice in Fantasyland? You be my guest. All right, let me show you the next one here. Oh, also the $400,000 per year for life, tax-free. Come on, guys. Like, this stuff is so frustrating, man. It's so frustrating. There's so many. It's like, this is why it's one of the most misrepresented products on the market right now. It's why IUL gets so much pushback. It's not the IUL itself. It's how it's marketed like this. This is ridiculous. So let me pull up this other one. All right, positive arbitrage. This is just bullcrap, but let's have some fun with it.
Ever wondered how banks make money on loans? Well, it's all about arbitrage. But here's the cool part. You can use the same strategy to grow your wealth. Let me show you how.
So he's actually right on this part, where like the bank will pay us what, let's say 1% on our savings account. It's higher right now, but historically speaking, they don't pay very much. Say it's 1%, and then they lend it out at 3, 4, 5%. That's positive arbitrage. That is true, but that's not what he's talking about with the IUL.
They borrow money at a low interest rate, say 1 to 3%, but then they lend it out at a higher rate, say like 5 to 7. The difference, well, that's arbitrage. They're making money off the spread between what they pay and what they collect. But what if you could do the same? Here's where it gets interesting. You can actually use a strategy just like this to participation loans on certain index universal life insurance policies, or IULs. This strategy helps you leverage your own money the same way the banks do. IULs are life insurance policies that build cash value based on market index performance, like the S&P 500. Now, you can access this cash value through participation loans, which means you can borrow against it at low interest rates while your cash value continues to grow. So here's the magic. Let's say you borrow at a low interest rate, like 4 to 5%, but your policy is earning index-like returns that could be 6 to 10%. The difference, you're using positive arbitrage to grow your money while paying back a loan at low interest. Now, just like banks, you can use this method to leverage your cash value and make money on loans while your policy keeps growing. It's a powerful way to build wealth and take control of your financial future. Want to learn more on how you can use IULs and participation loans to grow your wealth? Follow me for more tips on smart financial strategies and how to make arbitrage work for you.
It's a horrible financial strategy, and it gets a lot of people in trouble. He didn't talk about anything regarding like what you use the policy loan for. Guys, you don't just take policy loans just because you might earn a little bit more interest in the policy than what you borrow. What are you using the policy loan for? Okay, like I said, what you pay on the policy loan and what your policy earns is insignificant when you have the right strategy in place. See, like when I think about infinite banking, because that's ultimately part of the infinite banking strategy, is using our setting up a really strong financial foundation with cash value life insurance. It's specifically used with custom designed dividend paying whole life insurance policies. You don't want to do infinite banking with IUL. I strongly recommend against it anyways. But we build the foundation with the whole life policy, and then we utilize the policy to build wealth like we normally would. So for me, I like to build wealth with real estate. Right now in my real estate career, I like being a private money lender. You don't have to do that. You don't even have to do real estate. Maybe you use the policy to invest in a business, or maybe you're a really good stock trader. I don't know, right? You got to figure out your investor DNA, your risk reward profile, okay? But figure out what works for you. But I'm not just borrowing against the policy simply because I might be able to earn more within the policy. It's not why we set these things up, guys. Can it happen? Sure. But what if, like with an IUL, what if you get a 0 year? Where's the 4% coming from? Let's say you don't earn 6% that year. Where does the 4% of interest come from? It comes from your cash value, guys. So you can actually go backwards if you're not careful, right? Because the market does not go up every single year. You're not going to earn interest in your IUL every single year. There's costs, fees, expenses. Plus, if you have an outstanding loan balance using participating loans, that interest has to come from somewhere. Okay, he fails to mention that, where if you don't actually earn the 6%, then you're going to have to pay the 4% in interest. Oh, but don't worry about that. We that's not a big deal. That's not going to happen because you're going to average 6% per year. Average rate of returns, complete scam. Not a complete scam, but it can be very misleading, particularly in situations like this. So here's the thing, guys. So I use whole life insurance for the infinite banking concept. It has been phenomenal. The way I use my policy is I borrow against my policy. I just did a deal, another real estate deal. I borrowed at 6%. I lent it out at 13% plus 1 point. That is positive arbitrage, but I created that. I'm not trying to get positive arbitrage within my policy. I'm getting positive arbitrage outside of my policy by using my skill set. One of the things that comes up when you start learning about whole life insurance and infinite banking is that you realize that you are your greatest asset, and whole life insurance just helps you be better at that, right? Because it provides such a strong financial foundation and provides so many benefits. But I created that positive arbitrage. It didn't just magically happen in my policy. Here's the other side of that conversation is I don't give a crap really what the policy loan interest is, the interest rate, and what I earn in the policy. So my policy earns on average about 4% over the life of the policy, 4% internal net internal rate of return. but I just said that I'm borrowing at 6. So I actually have, if you were to ask this gentleman, he would probably say that's a horrible situation. You have negative arbitrage in that scenario. But do you? Well, I suppose if you're just looking at the interest rate, then yeah, that would be a bad situation. But why don't we actually look at, like, actually run the numbers and look at what we pay in interest versus what we earn in interest, and you'd be amazed. Which I've done this on my channel, guys. If you want the video, drop a comment down below. I showed an example of borrowing against my policy at 8%, like worst case scenario, and only earning 4. And over 5 years, like a car loan, that was the example. I earned more money in my policy than I paid in my policy loan. How is that possible if I paid an 8% interest rate, but I only earned 4? It's because of the difference between simple and compound interest. That's why I don't really give a crap what the policy loan rate is and what I'm earning in my policy, because I'm not trying to create positive arbitrage within the policy. I don't care. Now, if it happens, great. I'll consider that a benefit, sure. And if I can get a lower interest rate using like a cash value line of credit, then yeah, I'm gonna do something like that. But I understand the difference between simple and compound interest. I know that if I pay 6% interest, I'm not actually paying 6% interest, assuming that I'm paying the policy loan back, which you should be. If you're not, then you have no business doing any of this, right? But assuming you pay your policy loan back, you're not actually paying 7%. The 7% just determines the amount of interest applied at that particular time. But as you pay the policy loan back, pay that policy loan down, and you're lowering the balance, that 6% interest rate is now being applied to a lower and lower and lower balance. So by the time you pay off that policy loan, your total effective interest rate would be far less than 7%. 7% just determines the payment amount. All right. But with that, like, that's such a huge difference between simple interest and then with compound interest. That interest is being applied to a higher and higher balance, right? That's why the difference in the interest rate doesn't really, it's not significant. It's not a huge part of the strategy here, the equation. It doesn't impact how we use the policy, right? That's not why we're setting it up. We're setting it up so that we're setting it up because we understand that our greatest asset. We want to create a really strong financial foundation. We want to get all these benefits that dividend paying whole life insurance provides. And then when an opportunity presents itself, I'm going to borrow against that policy and I'm going to take advantage of that opportunity, whether it be in your business, real estate, private money lending. I don't care what it is. You figure that out for yourself. Obviously, it needs to be calculated risk. You don't just, like, I wouldn't borrow against my policy and invest in the latest cryptocurrency scam because I think it's going to go to the moon. That would be stupid, in my opinion. Right? You take calculated risk with this particular strategy, but in order to create positive arbitrage. We're not trying to get positive arbitrage in the policy, guys. If anybody's selling you on that, just run the other direction, all right? Or that should at least be a really big red flag. You should be thinking about, how do I create positive arbitrage outside of the policy? That's just my opinion, though. So what do you guys think? I think this stuff is absolutely ridiculous, and it is a huge black eye on the entire industry, on strategies like the infinite banking concept, which is, I mean, it's one of the most powerful financial strategies I've ever come across. It has been a game changer in my life. It is phenomenal when it's done correctly. But crap like this just puts a stain on everything. And this is the kind of stuff that you really have to be careful with, guys. So just please make sure that you're doing your own due diligence, you're doing your research, you're educating yourself, you're watching as many videos as you can on both sides of the aisle. Again, don't take what I'm saying at face value. Go listen to somebody else that loves IUL, right? And just start to identify the pros and cons, advantages and disadvantages, so that you can make an informed decision about whether or not this makes sense for you, that the strategy makes sense. Maybe you want to do an IUL, maybe you want to do whole life, maybe you want nothing to do with either. All right, but you need to come to that conclusion on your own, and you can only do that by educating yourself. All right, so anyways, I hope this was helpful, guys, and look forward to the next one. Talk to you soon.